for having me here today. I have experience with AI in the Albuquerque, New Mexico chapter. I did that for years. And it was wonderful, and that's where I live, not in Albuquerque, but in Santa Fe, New Mexico. So I was thrilled when I met Joan. We got along great, like we knew each other forever. Just met Dennis and Tom today, and I feel like I know them forever already. AAII has some really fantastic people, and I think the intention of AII really aligns with my intention, which is to try to help as much as I can educate people so that they really understand how to invest. And then, of course, the most important thing, which is when to take a profit, how much to risk, and really basically how involved one should be at any particular given time. So tonight's presentation is called How to Harvest the Best Investments. Joan and I discussed this title because of the month of October. This is the month of harvest, but also as we're ending 2025 in a couple of months, we've just entered the fourth quarter. Hopefully this helps you not only end the year, but really gives you a great blueprint for 2026. So let's get it going. So, I always like to have an outline. And so this is kind of what I hope that you guys get out of this, an aha moment, if you will. What are the opportunities right now for thinking for 2026? And then how do we find certain things using Phases, which is a navigation system that we have created here at MarketGauge. The momentum, which is something I'll talk more about when we get there. Of course, as we just talked about briefly, the market timing, sector rotation, because we know that's so important in this market. It's been really all about semiconductors and growth stocks, but what should we be prepared for outside of gold going forward? That's also been obviously a big thing this year. In fact, the biggest thing. I'm going to go through two algorithmic systems and what that means. And then, of course, Dennis mentioned about Q&A. What I would really like is I have no problem if you guys want to ask questions along the way. But in terms of if you want me to look at a particular stock, I'm happy to do that too. But we need to do that obviously at the end because it's going to mean going away from the PPT. So here I am. I've been in this business forever, at least it feels like forever, but it's the best business to be in. I started out, actually, I have a master's degree in special education, which has really served me well as being able to not only trade, but really educate people about trading in a language, hopefully that's very accessible to all types of learners, because let's face it, everything about the markets can be confusing if you can't access the simple rules. But then I wound up, by a very long story I won't tell you, winding up on the New York Commodities Exchange and the World Trade Center. This is when I was in my young 20s. And it was incredible. I spent 14 years down there, and I would say that that's really not only where I cut my teeth on the floor, but it's really where I learned about everything that we're going to talk about tonight. And MarketGauge, by the way, just real quick, which I am the chief strategist for, market strategist. It is really run by Keith Schneider is the CEO, who also happens to be my husband, and Jeff Bish, who is the president. And I say the three of us now, we've expanded to other staff along the way. The business has been around for 25 years, but a lot of the tactics and strategies that you're going to hear about tonight really have been created in a proprietary way through MarketGauge, and it's been my backbone, although I'm often out there doing my own thing. I did write a book called Plant Your Money Tree, which I think is kind of interesting considering this is called Harvest. This is Plant Your Money Tree. Here's a copy of the book. It is available through our site if you put in marketgauge.com/book. It was considered to be one of the top 100 best wealth books of all time. I won't repeat what Joan said, but it was quite an honor to win that award. I am on TV a lot. And I also have a creation that is completely mine called The Economic Modern Family. Anybody who knows MarketGauge and knows me has heard about them, and we're going to cover a lot about that too. And I just wanted to show you a little bit of some of the places I've been. Here's me with Charles Payne on Fox. I've been on other areas of Fox News. This is Schwab, David Keller, Yahoo Finance, BNN. Really basic. Asia is somewhere I'm a lot. This is from an Asian show. And then I do a lot of this kind of stuff with people that host their own shows, like this here is Maggie Lake when she was with Real Vision. So I get to talk a lot. And I really love what I do, and I love being able to share information. So essentially, what we really want to go over now is the whole training your trading instinct, right? And so how to measure and anticipate trends. And you see this little wheel here. We're going to go over this a little bit more. But essentially, the first thing I think, and what my book covers too, is about these market phases. Let's face it, at this point in time, even though I know how to get most places, I don't do anything without my map quest anymore because of, Apple CarPlay. I can always have a map up to see where I'm going, or if there's a better way I'm going, a navigation. And that is essentially what phases are all about. And we're going to get more into it. But I think it's really the pulse of everything I'm going to talk about, because if you know where you are and you're not lost, or you think you're going north, but you're really going south, or the market you think is going to go north, but really is giving you signs of going south. These are all important things to know, and there's a whole system for that. So, in terms of phase changes, again, I just wanted to give you a little bit of a background here, but we've got two very simple moving averages that we're going to talk about this. I don't like charts that are complicated. We have other things we'll be seeing as I add on certain indicators, but essentially I use a simple 50 and 200-day moving average. And sometimes I'll throw a 10-day moving average in there, but I also look at a weekly chart. And then I use 50-week and 200-week moving averages there. I use some exponential moving averages as well. I use look at a monthly chart, which has completely different moving averages, which we will not have time to cover today. I use a 30-minute chart with all the floor trader pivots, S1, S2, S3, R1, R2, R3, the midpoint floor trader pivot, and I use 1-minute charts, and I use opening ranges. Unfortunately, I can't go through everything. So what I chose was really so you can see my mindset on before I actually click buy. What do I have to see in order to make an investment in a stock? And since you all did the survey and there's no day traders here, we're going to leave that out. But you should know that anything that we talk about can also be applied to day trading. It's really just a matter of fine-tuning risks and rewards. So as far as determining phase changes, like I said, a longer-term trader, the phases are great. We can see a phase last from days to years. Sometimes things change phases and they fake out, and sometimes they change phases and they stay in that phase for a very long period of time. But if you're a shorter term swing trader, you can actually, if something is changing a phase, is when you have the best momentum and the best risk reward. So we're going to talk a little bit more specifically about that. If you just want to catch something as it changes a phase, get out, move on to the next thing. What's also great for option traders is that when you know when things are changing phases at this price or that price, you can actually buy a call or buy a put, depending on what you're doing, close to where the actual number is of where that phase is changing. And then you can kind of have options out of the money based on that as well. So it really actually, the strike prices really relate well to this. And then again, even though there are no day traders here, sometimes when something clears a 50-day moving average, you're going to get a big move that day, and that might be enough for you to just kind of move on. So now let's go through this wheel a little bit more carefully. So it's in a wheel, but that doesn't necessarily mean that things always follow so well in terms of like a clock. But what you can really see here is, we're going to start at the top. What I've done is I've assigned emotions, because so much of the market is human emotion. So when we're in a bullish phase, like we're in right now, that equals euphoria, right? So this is when everybody's just so super excited. But we know that euphoria only lasts so long. And eventually things creep in that give us concern. And we're going to talk a little bit later about what might create some of that concern. But for now, I really want you to get the idea of how things flow in terms of these phases. So if we're starting with this bullish phase, which everybody has heard about, what happens is something will then go into a caution phase. And that's when you start to see anxiety building up by investors. You start to see money coming out of the market, profit taking, short selling, what have you. And sometimes it immediately goes back right into a bullish or euphoric phase. It's just like, never mind, I should have been concerned about that, but I'm not. And we've certainly seen plenty of that in this market as well. But sometimes it gets worse. And when it gets worse, the news gets worse or whatever it is, more money gets poured out. We go into what we call a distribution phase. This is when really fear hits the market, right? And that is distribution literally is when cash is being redistributed out of the market into cash or into bonds or whatever the safety play is at that time. And then, of course, things can go from bad to worse, and that's when we go into a bearish phase. And a bearish phase is really despair. Oh, the country's no good, the economy is terrible, inflation's out of control, or we have a war. Whatever it is, that despair can last from a few months to a couple of years. We have not really seen an extended bear phase ever. We have seen them go 2-3 years. We have seen a market stagnate. People don't even realize that we can see a market go sideways because we've not used to that. Anybody who's been born in the more recent times. But from 1968 to 1982, so like a 14-year period, the market just went sideways. Wasn't always in a bear phase, but it was in a nowhere phase. But what's so wonderful about human nature and about markets is that eventually something happens to bring back hope. And that's what we call the recuperation, or some people call it the recovery phase. And that is the best opportunity to make money, in my opinion. It's my favorite time because when you catch that hope, you're catching just the smartest investors at that particular point, maybe even some of the institutional investors, but you're not really going to hear about it on the media until we get into an accumulation phase or when people start to get more optimistic. And then, of course, we go back into a euphoria or bullish phase. And like I said, you can go back and forth into these phases. You can go bearish to recuperation, back to bearish. But the point is that you need to identify what phase you're in, not just in the overall market or the indices, but any particular instrument that you want to trade. And every instrument is in a phase at some point because every instrument can be charted with a 50 and a 200-day moving average. Okay, so how do I determine the phase? There are 3 factors. One is where the price is relative to the 50 and the 200-day moving average. So if the 50 also relative to the 200-day, because I think that might be easier to start with that. So let's say the 50 is above the 200. So that would be a bullish phase only if the price is also above that. And we're going to see examples of this, so you'll be able to look at it visually. And the slope is also really important. So if you go into a new phase, let's say the 50 is over the 200, but the price is stuck between, and now the price clears that 50-day moving average, what's the slope of that 50-day moving average doing? Is it flat? Is it negative? Or is it starting to ascend? Because it's simple physics, really. If you start to see that slope move up, then you know the momentum of that phase is increasing. And I always like to think about it like a conductor pulling cars. The 50-day moving average, of course, will accelerate a momentum much faster than the 200, as if a conductor pulling 50 cars can start to get some acceleration faster than a conductor pulling 200 cars. So you really need to look at both to kind of get an idea. Is this a strong phase? Or is this a neutral phase? Or is it just kind of like a weak phase? And all of that goes into my mental process when I'm making a decision. So let's take a look at a bearish phase right here. So in every chart I show you consistently, the 50-day moving average is always going to be blue, and the 200-day moving average is always going to be green. So we know that. Now, this is a SPY back in like 08, 09, because it's just such a clean example. We have other examples, of course, but it's such a clean example of what happened with the bearish phase. So you can see I mentioned in a bullish phase, which we'll look at, the 50 was above the 200, and look at what happened in 07 We were there, right? In fact, the market was making new highs at that point. But look what was starting to happen here as we got closer towards the end of '07 before the big crash, is the slope started to decelerate in the 50. The price started to break down. We had a couple of fake outs here, but notice this slope here. And then when you start to see the 50 actually cross under the 200, that's called famously a death cross. That is really when we got the big move down. Now we'll talk about retracements, but you can see how long and how severe that bearish phase was. And it really, really was helpful, A, to get you out up here when you started to see it happen, but B, to keep you from getting overly invested until such time the phase really changed. So here's another really large bear move, and I just have to move this little thing here that has all of us here, so I'm going to move this down. But this is Dollar Tree. It just had a really massive technical perfect bear move. That's why I like to show it. So you can see the 50, it was above here, but the price was not there. So the price was already starting to wane. We broke the 200. We did get here into a death cross, and then it never cleared the 50. Look how long this thing stayed in a bear phase. So some people like to short, some people don't like to short, but just don't want to buy when it's going into a deep phase like this. And some people like to actually buy some kind of puts. And look how easily you would have been able to buy puts, let's say, buy like 100 out of the money puts when it was down here at 120. And I mean, just the volatility of that move was amazing. Now, the bullish phase is the one we love, of course, and that's when the 50 is above the 200. So this is another classic example of SPY in 2013. So look what happened here. We were sort of chopping around. The slope here was still negative. Remember, we do like to look at that slope. But as soon as the slope started to turn positive and we had this gap, that was really a great signal that this was going into a full-on bull phase, which we had a slight correction here, but notice what happened in this slope. The slope never went negative, so you kind of knew it was a correction. Not that I was going to or would have ever advised to sit through this unless you're a long-term investor, but you had another opportunity to get back here once it gapped up. And, then things got a little choppy. That happened. So remember, I mentioned to you that we can go from bullish to caution to bullish to caution to bullish. That's really when you want to make sure that your slope is up, as opposed to what I showed you in 2007, 2008, when we had a one little pop back up into the bullish phase, but the slope was negative at that point. So the best time to trade is really the start of the phase. I mean, you can see if you're looking at something like this and you're looking at it when it's up here for the first time, you have to say, "My God, this has been in a bullish phase for 7 months. We're really far from this 50-day moving average. Is this the best time to get into SPY?" And that's another question, is how far are we from the breakout of the phase? You can always get a retracement here. We're going to talk about that a little more. Or how far is the risk to the 50-day moving average? Because, things get long in the tooth, as we know. So this is gold. I mean, you want to talk about one of the greatest bullish moves. I've been a gold bull for so long. Since really 2018, I went on a Real Vision show, and somebody right before me had said that gold was at 1,000 and said that they thought it was going to go down to like 500. And then I came on and they said, "Mish, what do you think?" And I'm like, "This is the bottom. You should buy gold." And through the years, I've been on Kitco and interviewed many, many times, consistently a gold bull through the years. Why? Because I could kind of see the writing on the wall that gold would ultimately be the store of value that it's turning out to be. And of course, even if you were sitting under a rock and didn't know anything about gold, you can see here that when we got into 2024, here you had the golden cross. So I mentioned when the 50 crosses below the 200, here the 50 is crossing above the 200. So the opposite of a death cross is a golden cross. So here's your golden cross. Look how close you were to the moving averages there. You even had a little fake out, but remember right here, you might have gotten a little nervous, but we held the 200 and then boom, gold went off. And ever since then, we've had neutral slopes, slightly negative, but essentially this thing, every time it goes under the 50, you could take some profit, and every time it comes back, you can keep going in. And right now, what we saw today was gold traded at new all-time highs, 4,060. It's just been one of the most phenomenal bullish moves. Finally, you're starting to see some media coverage about it on CNBC. But quite honestly, nobody talked about gold for years, and it would frustrate me no end because when I would be asked by other types of organizations like Yahoo or Schwab or Kitco, I would say you should have 15 to 20% of your portfolio in silver and gold. And here's a classic reason why. I mean, it's been amazing.
Hey, Joan, or Mish, sorry.
Yes.
Hey, this is Tom. I kind of want to prime the pump for questions, but on the last page that you were on, like around, I'm just looking at slopes, okay?
Mm-hmm.
So July, when I look at the blue line,
Mm-hmm.
there's a slight negative slope, but
You're
then
talking right here?
yeah, but then you don't jump out. Is that just because it's not crossing the green line is
Well, no, this would be a caution phase, and that's a great question, Tom.
okay.
This would be a caution phase. And again, depending on what kind of investor you are, I'm pretty active. When I say active, I'm not day trading. But if I had bought gold when the phase just happened down here, or even if
Mhm.
I was kind of, well, maybe I don't really love it yet or whatever. I mean, I've always loved gold, so I always had every dip I would buy. But let's say after this dip, maybe I would have bought it here. Maybe I would have gotten out of here for very small profit, gotten back here. So now let's think about it. It's finally up here. At this point, I've taken some profits and I'm riding a tail. I might sell the tail when it breaks and then be flat. But then I'm going to patiently wait. Maybe I bought it here when it got back, or maybe I waited for the slope to be better. It becomes a timing game. I mean, the more longer you do this, the more you start to realize, well, if the slope is slightly negative, maybe this is a false breakout. But then look what happens here. It retraces right down to the 50 and the slope is back up. Here was a
Right.
great place for you to get in. And so, yes, you can get in and out unless you're a long-term investor. And a long-term investor might say, these gyrations up and down above the 50 I'm still so deep in the money that unless it really either A, breaks down under the 200, or even worse, breaks down under the 200, and now we're starting to see not just a distribution phase, but we're starting to see the 50 looks like it's going to cross under that 200. End of move, bear phase, the move is over. That's when you get out. That's really going to depend a lot on money management.
Okay. Thanks. Appreciate it.
Okay. Oh, no problem. Okay. So let's talk about how to use this actually for a trading opportunity. So we just kind of talked about gold a little bit. Sometimes you just miss it. And yet they're almost these moving averages like magnets in that there's a law of attraction. Most instruments, not all, but most instruments at some point will retrace back down to the moving average. That doesn't necessarily mean the move is over. And this is really where you have to kind of have a macro idea of what the overall market's doing. But like, let's say you're in a massive bear phase in the S&P and in NASDAQ, and your stock, you missed it on its way over the 50 because it's going counter the market and now retraces. You might say to yourself, well, the market's getting thicker into the bear move. Is this just a retracement or is this the end of the move? You always have to ask these questions, but let's assume everything is going fine, right? And it gets into a situation where it retraces. So like here's a situation now where this is the 200 is above the 50. So we already know anything where the 200 is above the 50 and the price is below is a bear phase. But look here, we crossed above it, but we never got above the 200 here. So let's say you missed this short. Now you get another opportunity. Look how your slope is going down to go short here. Then you get another retracement. It goes through it. Okay, so maybe you got back out. At this point, like I said, I'm assuming you're going to take profits. We're going to talk about that. But
Hey,
look,
Mish.
yes.
Sorry to interrupt, but we just got a question from from Harvey Fellett, and he says,
Hmm.
"Do you let capital gains influence your judgment about selling? And if so, in what way?"
Oh, that's a great question. And
Yeah.
if you're just a little bit patient, we're going to talk about that.
All right.
Because I really want to get specific with you about how I determine when to take capital gains. And are you talking about tax situation, or are you talking about just, if he's talking about taxes, that's not something that I tend to worry about. When I was a floor trader, by the way, that was my first rude awakening when I made all this money, after having no money being a school teacher. And now all of a sudden I'm making all this money. And my accountant said to me, well, you have to give us 28% of your gains for Uncle Sam. And I'm like, what? I spent that money already. Yeah. So, I mean, in terms of the general question, you definitely always want to have your capital gains ready for when you have to pay your quarterly taxes, or at least that's what I learned. If that's what you mean. If you're talking about just in when, of course, when I want to take profits, that's another story, and we'll get to that.
Okay.
Now,
Okay,
in
good enough.
and
It's not clear, but Harvey, if you want to clarify that, that would be great. Otherwise, we'll just say it's not for taxes right now and
yeah,
keep
yeah.
going.
And you should
Thanks.
definitely talk to your tax accountant about all of that kind of stuff about capital gains and taxes, and when, and then how losses go into that as well to offset capital gains. Not my wheelhouse, sorry to say. But anyway, this is really obviously a stock that, this is, by the way, IYT is the ETF for transportation. So this was where it was going into a really negative phase. And you can see how the slope was going down. You had that one little tracement here, but look where it retraced right down up to the negative slope of the 200. And then once it broke down under the 50, you had another opportunity to go short. And look how long that move lasted until it finally got back through that 50-day moving average. So retrace and reverse is another way to look at things as opposed to just buying it when it actually breaks out of a phase. So here's another classic retrace of Dollar Tree, right? So we looked at that chart before about how Dollar Tree was in this massive bear market. But look how many times you had an opportunity. If you're a person who goes short, I mean, as a long-term investor, most of you probably don't. But nonetheless, if you were like, I want to buy Dollar Tree, I have to wait. You wouldn't have bought it here, but even though it retraced perfectly to the 50, and look at the slope on the 50, but you might have said, hey, good time to go short. Same thing here, retraces to the 50, good time to go short. So that's very often, let's see if I have a bullish example of that, a good time. Yeah, here's a great example. And by the way, speaking of cryptocurrency, I heard you announce, I trade a lot of cryptocurrency, and Solana was one that I was particularly interested in for a while. And what's so great about crypto, if you know nothing about cryptocurrency in terms of all the fundamentals, because let me tell you, I go on these webinars with people who are like brainiacs about crypto. They know every single nuance, all the regulations and all the changes. I'm a trader. So I will tell you, as a trader, the greatest thing about all cryptocurrencies is how technical they are. Like if I was back on the commodities exchange and I could trade the futures in cryptocurrency, it would have been the same thing like trading sugar, which I did, and oil, which I did, and gold and silver and copper and all of that. So that's why I'm showing you this, but also as a great example of a retracement. So this was in a bear phase. Here's your death cross. It kind of retraced, but didn't really go anywhere. You still had a very neutral slope. You finally had your golden cross here, but let's say you didn't want to pay up like this because you're nervous. Look how great this was when it retraced right down. And then the next day was a green candle closing above the day before. It was almost like the perfect opportunity to buy at this particular point, and look at the money you would have made. So like I said, if you miss something, if you look at a phase change too late, either move on or just in your flow of looking at charts every day, if that's something you do like I do, say, you know what, I'm going to set an alert when this thing gets back down to the 50-day moving average. I want to be alerted, because what's great about all trading platforms is you can set these alerts. Now, one of the things I wanted to show you is it's really hard to try to keep track of every single phase change all the time, right? So we at MarketGauge have this thing called the ETF monitor. It's part of our Big View package. So essentially what it does is it tells you every single instrument from sectors to indices, um, mostly sectors and indices, emerging markets, and it tells you flashes when it's changing a phase. So that's really convenient. So let's say that recovery phase I was telling you about, you wanted to know if something was actually changing to a recovery phase. You can see here it actually turns purple when it's already not highlighted. It's already deep in the recovery phase. So like here, this is already in a bullish phase kind of thing. And that's really a great thing to have. This is a tool that not only tells you when it's changing phases, but it also tells you something you're going to learn about with me in a little bit about momentum when the momentum is changing phase, which is also extremely useful. So I just wanted to point this big view out. We're going to talk about that more later. So speaking of momentum, let's get into it. But just to sum up, so you can see that just everybody should have a 50 and a 200-day moving average on their charts, regardless of what else you like to look at, whether it's a 5-day, 10-day, 20-day. I mean, I would use the 5200. Why? By the way, I forgot to mention, this is what institutions look at. They look at the 50 and they look at the 200. So it's a very popular two moving averages. Same thing with the weekly, the 50 weekly and the 200 weekly. And again, if something is changing phases, clearing the 50, clearing the 200, death cross, golden cross, or you miss it and now it's retracing to the 50. Well, look at the slope, look at the price risk. We're going to get more into that. And just that alone, with if you knew nothing else, I can't tell you how much money that simplistic thing could make. I'm going to add layers to it on because I can, but I have to tell you that sometimes I don't even look at all this other stuff. And I just like say, wow, I've been waiting for this thing to clear the 50 because it's been in a bear phase for so long. Slope starting to neutralize, turn up. I like this particular company for whatever reason. Now it's in a recuperation phase. And like I showed you before, by the time everybody else catches on, I'm already in the money. And then it can go to accumulation all the way to a bullish phase. So keep that in mind. Okay, now the next thing is one of the things that when Jeff, Keith, and I, we're all on the floor, momentum. So momentum is something when you're on the floor, which doesn't exist anymore. That's, they're dead now. But if anybody saw the moving trading places, if you can't think of what the floor looked like, trading places has the quintessential scene at the end on the floor where they're trying to break the back of the orange juice futures market, and that open outcry, that was going on the floor. That was the environment I was in for 14 years, and it's all about momentum. But you can feel it, you can taste it, you can see it. Sometimes you can smell it, and you can certainly hear it. But we don't have that advantage sitting here in front of a computer. So we came up with a way to measure momentum, and we call it real motion. And I'm hoping that I can give you a really good sense of what that looks like by the time I finish today. So what it basically does is it takes these price patterns I just showed you, particularly on phase changes, and it makes them a little bit more predictable. So it adds a level of confidence. It also sometimes tells you something is running out of steam even before the phase changes, or the opposite of that, it can confirm a trend because the momentum is switching to something more positive before you see it in the phase change, or vice versa. The phase changes and now the momentum starts to catch up. So what am I talking about? Okay, so let's go through. I just mentioned this, so we're going to skip that. Let's go right to it here. So this here is what we like about momentum is that it can really, remember I showed you a couple of the fake outs there where like SPY broke out, but really it just failed right after that. We would consider that a fake out. That's going to happen, but this layer of momentum really kind of helps. So essentially, what we're going to do is we're going to look at in the NASDAQ 100 how the momentum helped us get the sell alert before, let's say, the phase change, or the buy alert before the phase change. And then also where things started to get a little long in the tooth. So I'm gonna skip. This is an NVIDIA chart, but let's go right to the actual real chart because I think that's going to be a lot clearer for you. Excuse me. So the way that our momentum indicator works, or our real motion indicator works, is we use a series of dots, red dots. Red dots actually signify the momentum. We also use a simple 50 and 200-day moving average, right? And this is the price, 50 and the 200-day moving average. So what we want to look for here is in this particular SPY chart that you're seeing, this is where you want to look to see if momentum is either in the same alignment as the phase and the price movement or starting to diverge. And so we're going to talk more about this here. But here you can see the red dots right now are under the 50. Look at the price. It's over the 50. So to me, this would have been an idea of when it started to retrace down to the 50. As I told you, that's often a good time to buy. Maybe not, because look at our momentum is declining. So this was looking like a retracement, even with the positive slope, to actually maybe something a little bit worse happening. And you can see what happened. The momentum was telling us that we were ready for a little bit of a correction. Here's the same thing. The momentum was finally starting to change, but the phase was already bullish. So this was not really leading in terms of the bullish phase. The price was leading, and then the momentum never really caught up. But, so it's not perfect, but what you really basically want to see is the dots lead the price, then wait for the price. Okay? So let's show more examples of that. This is Tesla. Okay, so here's a classic. This is one of my favorite examples. So Tesla, here's your 50. This had a golden cross right here in momentum. And look where the dots were above that. But look where the price was at the time. It was just hovering over the 50, but the 50 was still under the 200. So what this was telling me here, that the momentum was starting to improve before the price. So the price was under the 50 and under the 200, while the real motion momentum now starting here is not only clearing the 50 and the 200, but look what happens. Even long before this cleared the 50 and the 200. So here, once you got this move, even if you were just sort of like waiting, once you got this move over the 200, the momentum was already telling you to anticipate this. But we would have looked for the confirmation of the phase change before we got in. And it turned out to be an incredible opportunity, because if you look at the price at the time, Tesla was trading at around 200, and it went all the way up to about 300 before things started to change. Now, here is the opposite of that. So now what we're seeing is the momentum here is going into a death cross, right here, as the price is still above the 50 and the 200. So the momentum improved here, but not the position of the two moving averages, whereas here we still have very much of a bullish phase. So what we knew was either A, it was time to take profit, or B, you're going to expect the moving average break to follow through, because the momentum was already telling you that the Tesla stock move was over. And sure enough, even if you would have waited, you would have seen that it was time to get out here of the rest of your position if you had still had a position. And of course, you can see what happened to the Tesla stock there. So the point is that A, sometimes you want to see the momentum and the price go in tangent with each other. That's fine. That happens a lot. But it's really interesting to me, particularly at the beginning of a move or at the end of a move, when you see the divergence. Momentum is doing one thing while the price is still doing something else. That's really, I think, the clarity of the phases with the real motion indicator. Now, this is just showing you without the real motion here, some of the price fake outs that you see here. So it went into a bearish phase here, and the slope was down. Here we can see another opportunity where it looked like it was basing out. We got the golden cross here, but it didn't really do anything. Then back here, we started to see failures up and down, up and down. Let's see what this looks like with the momentum indicator. So essentially, if we add the momentum indicator, here's telling you, you know what, even though this is going down, look at our momentum indicator here. Let's show the comparison. Here, we've got the dots over the 50, the dots basically trying to get over the 200. We've got both of the moving averages basically flattening out in slope. Obviously, the 200 is going to be stronger. So if you didn't want to get out of your position for wherever it was, it doesn't even matter what this instrument is, it would tell you, you know what, maybe I shouldn't sell. Maybe I should have a lower stop. Same thing here. It breaks down under the 50. Look at what the momentum is doing at that time. The momentum is actually starting to get stronger, right? So now here, finally, we break down under the 50. So maybe you would have gotten a little spooked here. But now let's move down to here. We are above the 50. We break down. Fakes out right here, gets back over the 50, but now look at what the momentum is doing. The momentum is breaking the 50. Now, over here is a different story. You can't just trust the 50-day moving average until you start to see the momentum. So here, you've got the break back over the 50, and look what's happening here. We've got the 50 and the 200. So it's essentially telling you, don't sell when the momentum is still good, maybe move your stop, and don't necessarily buy if the momentum is starting to decline. So this is BABA. I just wanted to show you some of the divergences in a real chart here. Here's your red dots. So look at BABA here. BABA was starting to show a good divergence here in that it was clearing the 50. At the same time, though, it actually did it before the price, but we could see we never cleared the 200. Then when it started to come down, really when things got interesting was when it cleared both the 50 and the 200 here, and it only cleared the 50 here, and then eventually the 200. And then here, just when you thought BABA was really going to continue to do well, not only were we starting to break down, but we broke down in here before we broke down here. So it would have told you not to buy more on this retracement, and maybe it's time to take a bigger profit. And that's kind of how you put it together. Now here's the opposite, right? So here's BABA recent divergence. I wanted to show you this because a lot of people are long Alibaba. And so this is the price right now. This, by the way, we're not going to talk about this today, but this is our leadership indicator, what part of our triple threat play. This tells you if the instrument is outperforming or underperforming the SPY. The blue would be the instrument, the red would be the SPY. So you can see Bob is still outperforming, but look what's happening here. So I didn't really talk much about the Bollinger Band, but we can see now that it's breaking down on the Bollinger Band. I don't know if you are familiar with mean reversion, but that's when a lot of people are talking about mean reversions. They're saying something is reverting to the mean, means that this might have been looking a little bit overbought, and it's reverting to the mean in terms of the momentum. But at this point, we're still not necessarily seeing anything negative with the momentum. It just gave you the clue to not keep buying up here as it was reverting to the mean. And we'll see what happens to BABA down the line, whether it's ready for some kind of correction or the red dots go back through the Bollinger Band and we make and continue to go up to new highs. So this is Viking Therapeutics. This is a brand new position. So I wanted to show you something on how we made the decision to get involved in this particular stock. In terms of diversions here, you can see right now the 200 is up here in momentum, the 50 is down here. The price started to clear over the 50 long before the price did here. So your first opportunity really was here when it started to get out through the 50, but it didn't really go anywhere. It kind of went sideways. But what it would have told me here is as it broke to the 50, don't sell. Right? Remember we said don't sell. Why? Because momentum never broke the 50. So maybe we would have bought it here. Maybe we would have been a little bit underwater here, but I probably would have said, you know what? This low day, let me see what happens the next day. If it keeps breaking, I don't care what happens here, I'm getting out. But instead what happened is it went back through the 50. Now, I didn't buy throughout this whole period because the whole thing was going sideways. But this is really where it got interesting. We had a golden cross in the momentum here. This is when we got in. And we had the this well above the 50, but you can see right here that the momentum now was starting to shift positive. So it looked to me like it was time for this to take out the 200. I waited for that because it was too far from the 50. And once it cleared over that 200-day moving average, it was time to get in. And you can see what happened with momentum, and you can also see it started to outperform. But let's look at where Viking Therapeutics is right now. Now, we got out of it. We got out of it because we took some profits. We did not get caught in this big gap right here down. Why? Because look what happened, the momentum here. As the momentum was starting to go up, we could see this day before the earnings, right here, I'm going to show you a line. This was showing us now that the momentum was starting to peter out with the dots. And so we didn't get caught up in this. We were fortunate. Sometimes you would have get caught up. But remember, buying down here wouldn't have even been that much of a disaster. But instead, you had a new opportunity because here you had the dots over the 50, outperformance here over the SPY. And this went over the 50, went over the 200. And this is something we're going to learn about in a minute called the calendar range. So when you get into this, we're going to talk about risk reward and all of that and how you set your stops. But you can see that the bullish divergence happened before the price divergence. And that's kind of when I'm watching something I want to buy, that's what I'm looking for. Here again is a negative divergence in SPY. This was in right before that crash in April. I was not long. I got out of everything. Why? Because of my momentum indicator. I could see the market was getting tired. By the way, other things in the Modern Family were already starting to fail before the SPY. But nonetheless, you could see here the momentum started going south even before this broke the moving averages. And then after all of the big crash, even if you didn't buy the bottom like so many people claim to do, it doesn't matter. Once this started to get back into a bullish divergence of momentum and clear the 50, you kind of knew the worst was over, and certainly it was. Okay, so simple rules for applying, just to review. Real motion leads price if you want an edge. You want to trade when the price action confirms the direction of the real motion. You want to focus on low risk and highly divergent situations around that 50 and 200-day moving averages. The closer you can get to those moving averages, that's the lowest risk you're going to get. Then watch the moving averages first and then the dots, right? So that's kind of sums that up. Okay, so let me take a sip of water here. Any questions at this point? Okay, I'm going to keep going. So now let's talk a little bit more about timing trades. So you see that I use phases for my navigation. I use momentum to confirm that the navigation is pointing me in the right direction. And now let's talk a little bit more about how do you get in? How do you determine your risk? And when should you start thinking about a profit? Okay, so we saw basic chart patterns on the setups. So what we want to do is we want to figure out what's our risk. And if the risk is too great, I will avoid the trade, even if everything looks perfect on the chart with the phases and with the momentum. And what I do is I look at average true range. That's what ATR is right here, average true range. And the average true range will fit in really well. So basically, let's talk a little bit more about that. But we want to look at nothing more than about 2 to 3 of the average range of an instrument before we decide what our stop is. So the profit targets would be some multiple of the range. So for example, what we like to do is we like to look at, let's say, a instrument trades at about $1 a day in terms of range, and we look at it over the course of 10 days. I don't know if I show this or not. I may show this more clearly. We take the average high-low over 10 days, and we average that out, and that's how you get your range. If something trades about $1, I may be willing to risk $2 to $3 on the trade, provided it lines up with either a major moving average on the phase or a major moving average on the momentum, one of the two or both ideally. If it's too far either way, I'm going to avoid the trade. Then what I'm going to do is I'm going to think to myself, people say look left first to look right. If I'm going to willing to risk $2 to $3 on that trade, do I think I'm going to make $6 to $9 on that trade? And we're going to get into a little bit about the macro later. But if I think everything, all systems go and I have a good chance of doing it, then I will take the trade. So my profit target levels are based on multiples of that average range. So, oh yes, so I do get into it. So I just talked about it a little bit. So it's the true range of a stock over 10 days. It's used to measure the stock's personality, I like to call it, but volatility is another way. And every single instrument has a range, right? I don't care what you're trading, even if you're trading penny stocks, not that I think anybody here is, but everything has a range. Sometimes the ranges are just 15 cents a day, or sometimes they're $15 a day. And it's good to know what the range is because that's going to help you with your position sizing. Obviously, if something only ranges 15 cents a day and you're going to risk 45 cents, you're going to buy a lot more in terms of the number of shares than you are if you're going to buy something that trades $13 a day range and you're going to risk $26. You're probably going to buy very few shares of that particular stock. That range really helps you determine how much to buy. And position sizing, I got to tell you, I could do a whole webinar just on that, is probably the most important thing. It's what screws people up because they buy too little on the way up and they sit too long on the way down in much bigger positions. It's just human nature. We're kind of programmed to fail more than we are programmed to succeed. So it's available on most platforms. I use a lot of different platforms, but you can probably find it on most trading platforms if you look up how to find average true range. It really does help you. So in determining your risk, here's SPY. So remember, we talked about here buying it when it was sitting near the 50-day moving averages, and the slope was going up. So in this case, we can see that the ATR, we were willing to risk 2 ATRs or underneath that 200-day moving average. That means if we were risking 2 ATRs, we wanted to know that we could make probably 4 to 6 ATRs. And we did in this particular case. So I would have already taken profits. We're going to look at charts that are more specific. Now, we got out. We probably would have sold the rest on the phase change, especially what the momentum was doing. But we still like SPY longer term. So now we're going to buy it again once it clears the 50-day moving average. Again, with an ATR of $5.47, we could risk $10 on this trade. So in this particular case, let's say we're getting in at around 435. If we risk the 425, we are now under this 200-day moving average. But that also means that we want to make $30. So that means we want to make it to 475. We got that. We take our first profit target. Then we want to maybe make another $30. So we got that too. We got to 505. We took another profit target. And that's really when you start trailing up your stops. So that's why I'm saying I love to use the initial risk. If I think I have to risk way more than 2 to 3 ATRs, I skip the trade. And I have to really believe that I think I can make at least double what I've risked, okay? So here's another one. This is Chewy. I just love this chart only because this was an earnings thing. And what happened was, here's your ATRs, $1.25. This day, Chewy gapped up above the 200-day moving average. It had good report. So at 2160 was really where we started to think about buying this trade, right? So that would have been right around here, right where this arrow is. So if we're going to risk basically under we were going to risk basically $2. So if you're buying it at 2160 and you're going to risk $2, that means you're going to risk down to around 1960. We didn't even have to risk that much to under the 200. But that also means now that you want to make about 260 times 2. So you want to make at least $7.20 to $9. And look what happened here. You had this great spike. This was the buy opportunity, the sell opportunity. Sometimes we use limit orders and something like this. But you can see that here again, you had another opportunity. It went all the way down. You could buy it again with a really tight risk and on and on. So on top of the phases and on top of the momentum, I have to see my way to a 2 to 3 ATR risk that makes sense, and I have to see my way to being able to at least double to triple or quadruple that in terms of multiples of ATR to get my profit. So here's IBM. The ATR at the particular time, they changed, by the way, was $6.68. got lucky, I will admit. I did not know it was reporting the next day, or I probably wouldn't have bought it, but I got lucky. And the reason why I bought it, and we're going to talk about these horizontal lines in a bit, was because we cleared the 50, the slope was up. Look at the momentum. The momentum here was starting to get into a bullish divergence. Here we are over the 50. So I'm like, okay, $12 risk, easy peasy. It was down to this low. Well, I had a $12 risk. But instead, I woke up the next day, I'm like, whoa, what happened? Oh, it reported well. So sometimes you get lucky like that. But even if I didn't, you can see the risk reward was really great. And by the way, just to show you, we had the mean reversion here. So we had already taken some profit at around 260. And then we got out of this trade when the momentum started to break down here. We got out of the rest of the trade. I think we left a little tail when it finally broke under the 50. So that's how I use this. Sometimes I get all my ATRs, and sometimes I have to get out because the momentum in the phase is changing and I don't want to lose money. Capital preservation. Here's another one. This is silver. Okay, so silver has only it has more now, but at the time a 57-cent ATR. Look at your momentum here. The momentum was beautiful. It was clearing the 50, it was clearing the 200, just the same time the price was. So I only needed to risk about $1. So we entered at around 22. We risked about $2 under the 50-day moving average, which turned out to be under $21. And again, that means if we're risking $2, we wanted to make $4. We got that easy. And once again, we just used the momentum to kind of time our way in and out. Silver was not easy until it broke over $34 an ounce. And this last move from 34 to now, $34 an ounce, $34 in SLV. It's actually at $50 an ounce. 34 to 44 in SLV has been some of the easiest money that anybody's ever made because it happened so fast. Just another quick example, ATR is $1. This is XLU Utilities. Again, I don't have real motion on here, but you can see it broke over the 50. Then it broke over the 200. You got a nice little entry here with a $2 risk to under the 50. It never really broke down under that 200-day moving average, and that's when it had its massive move. So sometimes you have to have a little bit of a patience. Okay, so we talked about the stop loss. Confirmed failure of a phase can get you out. Your initial might be 2-3 times the instrument's ATR, or the low of the last trading day beneath the phase change. We can look at that in a little bit. The art, there's some science and there's art to decide which stop loss to use. Okay, we talked a lot about profit, so I don't want to take too much time because it's already, my God, I've already been talking for over an hour. But essentially, the best thing to do psychologically is not only have your targets in advance, and a trading journal really helps, but also once you get 2 ATRs, if you risk 2 ATRs and now you get 2 ATRs, put in a no loss stop. Then at least you can walk away from the trade and say, hey, worst case is I break even on the trade. You don't want your winners to go bad. It also really helps you, like I said, psychologically. I know it helps me because we know that this is a mental game in terms of your own psyche at all times. So once I'm in something, like for example, HIMS, I bought HIMS. I put my initial stop very tight, like only 1 ATR lower. But today I got a nice little cushion of 1 to 2 ATRs. I'm at a no loss stop. Whatever happens, I'm going to break even on the trade unless it has a major gap down. That can always happen. But that's where your position size comes in. I position size initially for the possibility of a $2 loss, which means I know from based on my equity how much I'm willing to lose on that type of trade. And then once you're in an actual trending, use wide trailing stops. You don't want to get knocked out on one bad day, but you don't want to lose money either. So again, you want to use a trailing stop, but you want to give it a little room for some volatility. So let's continue. Let's go to here. So this is GDX. This is the gold miners. So one possible trade entry is here. And you can see with this one, you would have risked to probably under the 50 or the day that it actually cleared the 50. So right here. So let's say you would have, this looks like it's at about 1375 and you would have entered it at around 1450. So that's one thing. Then if you're going to risk that much, like let's say 75 cents, that means now you want to make about $2.50, $3. So you got 3 times your stop loss right here. So this is your first profit target. And then you can see where that was. And then now you want to take your stop under the support level. So if you got in here and you got out here, now you want to raise your stop so that you don't turn this into a loss underneath your next support level, which would be under this gap and under the 200-day moving average. And you see where it goes. Okay, so here's another one. This is SPY. So here we had our phase change. So you might have gotten here. We see the ATR. I showed this one to you already, 547. We had that $10 range. Look at where we did 3 times our stop loss and profit. And then we took our second profit after it actually broke down under that 50-day moving average. Here's that Chewy trade again. The possible entry there, the 3 times the stop. And then, of course, basically what we started to do was have our, this was the initial, these things are not going in sequence. It should have been 1, 2, 3, 4. I'm sorry about that, but I didn't understand the timing on this one. Okay, let's see what happens here. Possible trade entry there, ATR dollar. Let's go to all 3 of them. Here's your stop underneath the 50. Here's your 3 times the profit. And then boom, you know, this may be where under the support level is where you got out of the trade. Okay, so let's put it all together. You have your entry, you have your target, you have your stop level, and does it add up to a 3-to-1 or greater risk reward? So now let's move on, because I'm going to move on a little quickly here, and nobody's asking any questions. I imagine you're absorbing this. The good news is that you will get this as a recording, so you'll be able to listen back to it. So one last layer I want to show you, and that is the calendar range. So essentially, I can't go into it too much, but we like to use 2 different calendar ranges, the January and the July. So the January starts the year out. It happens after about 10 trading days into the year. Essentially, if something breaks out of the January trade or the calendar range, that usually means it's going to be one of the leaders. If it breaks down, it means it's going to be one of the laggards. We do the same thing in July. So we divide this year into 2 different sections. Okay. What we really want, and the reason why I'm showing this to you right now, is you want to see where the broad indices are, my key family members, which we're going to talk about real quick soon. And then you can see, oh, the market is breaking out of its January range, it's breaking out of its July range, or the consumer sector, XRT is, or the interest rates are. That's going to give you an idea. But ideally, this is what I really love to use, is I showed you the momentum, I showed you the phases, I showed you how to get in, how to get out, where to stop. If you're going to get a calendar range lined up with both the 50 and the 200-day moving average, that's almost like a technical dream, nirvana. Right, so this is just to show you, we're going to always see them depicted. The blue and the pink ones here are from the period before the July, and then the green and the reds here are for the January. But you're always going to see them depicted as the ones I'm going to show you as horizontal lines. So here's that gold chart. I just wanted to show you real quickly how I had everything in alignment for getting even heavier long gold than I already was. We had the phase change. We had the momentum improving, so I waited, right? Because the momentum didn't really clear the 200. Here the 200 is here, here the 200 is here. But look what happened. Just as the momentum was starting to change, we were clearing, in this case, the January calendar range, and that turned out to be great. Now here's July. We kind of chopped around. Look what momentum is doing. It's not looking so great. But then look what happens here. It wasn't July, it was already the end of August. It comes back through the 50, never really broke down under the 200, so I'm talking more short-term investment. Clears the 50. Look at how the 50 and the 6-month calendar range, the July, line up. Another unbelievable opportunity. Momentum, phase change, and calendar range all lining up for nirvana. Okay, so here is the silver. We talked about that, but let's look at the silver calendar ranges here. What we didn't talk about is look how this broke out of the silver July calendar range and then failed it, but did not break the low on this part. I wouldn't have even gotten into the trade here because look at my momentum. It was so negative. But once we started to get positive here, This is really where I'm interested in. Now, not only do I have a good risk under the 6-month calendar range low, but look what happened. Our momentum started to increase. We never really broke down under the 50. We had the retracement here, but we did clear the calendar range, and the 50 started to coordinate with each other. And now this is where I'm saying over 34, you had this parabolic move up. Let's move on from here because I think that I have a couple of other things I want to show you. So the last thing I want to show you here is macro. So I think it's always good to understand where we are in terms of time and space, not just in an individual stock, but what the macro is. So we love this big view. So basically, it has risk gauges, so it tells us whether we're risk on, risk off. It has market internals, so advanced decliners and all, oscillators and all the stuff that people use. Market sentiment in terms of the gauges, different types of investing styles, and sectors and global macro. But for us today, all I want to focus on is what I like to use. So I'm going to skip this because I think that I'd rather give you how I look at it. By the way, what's so interesting is right now, this is as of yesterday. This is the close of yesterday. Look at the risk gauges. This is the sentiment I was just telling you about. It actually was slightly bearish, believe it or not. A week ago, it was actually higher, and a month ago, it was basically where it is now. So people are telling you that there's a lot of investors into this market, and the bullish phase is euphoric, but the truth of the matter is a lot of people are looking for some kind of a correction here, and we're seeing that in the investment gauges. So I'm going to show you the ratios that I like to use because that to me is the most important thing. Okay, so we look at the SPY. The SPY is our barometer. It's our it's what we use for everything. So we look at the SPY versus the long bonds. We look at the long bonds versus the high yield debt or the junk bonds. We look at the SPY versus the gold. We look at the gold versus the wood. We look at the SPY versus utilities, and we look at gross versus value. And I know this is going to be a lot, but let's go through this. So let's skip all the definition and go right to the chart. So like I just wanted to show you right now, you just saw that in terms of the risk gauges, they're kind of almost negative, which is interesting because the SPY made another new all-time high. So you have to scratch your head and say, why? And you can see now, would I first be buying SPY if I just woke up? No, because it's so far from the 50. And the momentum right now is not negative, but it's certainly showing those mean reversions to the sell side. But this is so interesting. Typically, you have risk off if the SPY is underperforming the utilities. And look at how the SPY is underperforming the utilities. This represents the utilities, this represents the SPY. But why is this example different? Because utilities right now are rallying because of the energy demands of AI. So this has been kind of a switch. So this may not be the best gauge for risk off, but if we start to see XLU turn down, certainly that could be interesting. The other one is now let's look at the SPY versus the long bonds. Now we know the long bonds and interest rates have been a big football to try to navigate. Some people are thinking that the Fed is going to cut. Last time they did, rates actually rose. Some people think that the rates are going to continue to rise because of inflation. We don't care. We don't need to know. What we need to know is how is the SPY performing versus the long bonds. If the SPY starts to underperform like it did here briefly, or here briefly, the TLTs, that's a risk off situation. Right now we're in risk on. The other thing is the junk bonds should always in a risk on outperform the long bonds. Here we have right now, we had a period where the junk bonds were actually starting to underperform. This looked a little scary, but the market was continuing to make all-time highs, so we didn't care that much. Now we're starting to see the junk bonds come back a little bit. So again, you put these two together, we're still kind of risk on, but you know, one has to be careful. SPY versus gold, well, here tells the whole story. SPY has been underperforming the gold for months now, and you can see that ordinarily that would be risk off, but again, this is a very nuanced market we've got here. And in terms of recession fears, you want to see in a non-recession fear wood outperforming gold, but even wood is underperforming gold tremendously. So if you put this all together, really, it's very confusing. On one level, we have a risk on the other level, we have sentiment switching. On the other level, we have risk off with gold doing so much better. People are saying, what is gold warning us about? And on the other level, we have the potential for a recession down the road based on what wood's doing versus gold. So it is definitely a stock picker's market. I think that's mainly what we're going here. Look at value versus growth. A lot of people thought this was going to be the year of value stocks. And even though small caps have gotten to all-time highs, in terms of the real value stocks, they are really underperforming growth. Look at this. I mean, this is almost at historic lows here. So one has to say, at what point does this affect the growth market? Or at what point does value start to catch up because that rubber band is stretched? You can see how it's constantly trying to feed into all this information to try to figure out. So I wanted to show you quickly my sector rotation. I use the economic modern family. I've actually depicted them as characters. So this is Bitcoin, this is semiconductors, this is transportation, this is Russell's, this is retail, granny retail, this is Big Brother biotechnology, this is Prodigal Son regional banks, and they all have pets, by the way. So if we look at the explanation, granny retail, I use XRT, 70% of the GDP. If we look at transportation, I look at IYT. Obviously a big indicator of the how the sector, not only that, how the economy is doing. If goods and services are moving, good for the economy. If not, not so good. And then of course I call him Grandpa Russell, IWM. This is the small caps. This is what Stanley Druckenmiller calls the inside sectors of the U.S. economy. So I'm constantly, just as you saw how confusing it is, are we risk on, are we risk off, are we going to have a correction, what's going to happen, are things value so undervalued, gold going up, what's going on? I like to look here to kind of get an idea of what it's flashing. And I will tell you, because we don't have time to look at a chart, that XRT is now into a caution phase. Russells are still sitting pretty, and IYT has not gotten to new all-time highs. This is actually still far, far from the highs that were made in 2021, while Grandpa's doing okay, most likely because of the somewhat of a confidence on the fact that we're going to be reshoring a lot of manufacturing to the U.S. But those three are super important. But then we've got sister semiconductors. Semiconductors just keeps making new all-time highs. So that's where we're seeing all the money is just rotating into growth. Biotech has been, it's an interesting place. Speculators go in there when they're confident in the economy. They run out when they're not. However, it's a cyclical and uncyclical because we always need pharma. But then once again, we're seeing pharma now as sort of a tariff scare, a lot of confusion. But nonetheless, biotech has done actually pretty well. I mean, really super far from its all-time highs, but has held up pretty well in recent environment. And then, of course, there's Prodigal Son. I call the regional banks. The reason why I call them Prodigal Son is because they always get a bailout when the banks start to fail. And that, too, right now is in a caution phase. So you've got KRE and XRT, retail and banks in caution phases, this in a bullish phase, but so far from the all-time highs. Grandpa at all-time highs or a little bit close, just sitting underneath. And then you have sister semiconductors just soaring. So sometimes it's just really good to just follow the individual sectors, and that's where you're going to find your money. And in terms of Bitcoin, by the way, that's my newest character. I call him my tween, but that too has been really interesting. So I wanted to end with a chart of each one of these. So this is as of yesterday. XRT is actually now underneath the 50, trading down here. This was updated as of Sunday, I guess. IYT is actually down here. IWM is up here. And look at the real motion down here. So you're starting to see a failure. This has actually already failed the 50-day moving average. This is also starting to come down after a mean reversion. This is actually still doing pretty good. If we go to semiconductors, we're actually still up. Momentum hasn't really shifted yet. IBB, we're starting to turn down a little bit. Look at the mean reversion that's happening here. And regional banks today are back under that 50-day moving average, and the momentum came back down under the 52. So mixed, so unbelievably mixed. Instead of showing you Bitcoin, I'm showing you IBIT, because this is a way you can, these are the iShares of the Bitcoin Trust. That also, look at the 50 is underneath the 200 while the 50 is above the 200. We're sitting right here on the calendar range, 6-month calendar range high, but we haven't really gone anywhere in the momentum. So in terms of can Bitcoin roll higher, what we want to see is this momentum increase over the 200. We want to see this hold the 6-month calendar range, and we want to see this take out that 125,000 that has been the high so far. So just to let you know, we have macro and sector ETF models called GEMs, and we have a small mid-cap earnings growth model. We have about 7 other models. I just wanted to introduce you to the fact that everything I've been talking about is discretionary trading, but all these rules that I'm telling you about right now, we have applied to our algorithmic trading. And I just wanted you to know a little bit about what MarketGauge does. So if we look at the small and mid caps earnings growth model, look at how this has just been unbelievably outperforming the rest of the market here. If we just look at the earnings growth year to date, it's up 20.79%. This actually goes back to 2018 with a lot of back testing, but this kind of tells you that if you wanted to actually buy a model to subscribe to, you get the alerts, you get the stops, you get the targets, and that's one way to go. And the other one is, of course, our GEMs. This is global macro and sector ETFs. This also has had a tremendous return this year of 22.1%. These are all found through not only earnings and fundamentals, but also through our trend strength indicator. So I just want to let you know that everything I've talked about has been coming out of my head of how we trade, but all of this has been programmed with AI into these different models. So if you want to work with MarketGauge, I'd say the best thing to do if you're interested, like Real Motion or the calendar ranges or the phases, the ETF monitor, or even some of the models, the best thing to do right here is to call this guy, Rob Quinn. You can call his number or you can email him. I'm not even going to get into that. But we also have an asset management company, and that is MarketGauge Asset Management Company, where we actually will manage money for you, and we have all different types of blends depending on what your risk appetite is, including a discretionary component from our investment side. That, if you wanted to learn more about, you would have to call my husband Keith. He's the CEO. He's a Series 65, and that's his cell, 603-1277. So that's it.